My name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans. Beans in the teens, still, but this market, which last week looked as if it would be coming to a cusp, has seemingly disappointed once again. We still have the overhead gap, 1459 to 1467 from May 2014. We also still have the congestion stroke attractor at 1392. The flatlining short medium moving average currently 1391. The congestion at 1385 and 1365. And though battered and breached, we also still have the August to date uptrend currently at 1382. Though I confess this may need to be reassigned at some point. So why do we look like we were coming to a cusp last week? Well, it's because at that time it very much looked last Wednesday as if we were to have a weekly key reversal, possibly up. All the markets needed to do was to close last Thursday above 1403 or below 1391. However, last Thursday we closed at 1396 3/4 and gave us a lesser outside week to deal with. Initially, last Thursday's actions looked good, with a gapping higher open after the previous combined key reversal up and bullish closing long white Mariposa. Yet this bullish open soon turned into an immediate countering bearish dark cloud cover pattern as prices dropped back to the previously mentioned congestion and attractor that is at 1392. This left us with an outside week that provided no real direction. Since then we've had an indecisive doji cross, a small shooting star type 1 bearish pattern, and a small follow-on bearish engulfing pattern, just with what looks like today a possible bullish double. Yet through all this, prices are no further than they were 2 weeks ago or even 2 months ago at the end of February. We still have the threat of a double top that is now also a possible triple top and a possible sloppy ascending triangle. I'd add one more now. We may also have a bull channel from the start of January until now, currently 1360 to 1473. Again, none of these three major patterns are clear, though I confess to favouring the bull channel right now. It seems the clearest and the cleanest. Chicago soybean meal. I wrote 6 weeks ago, and I quote, "We're in danger, should we close below the new short-term uptrend, which has since been retired, of making a larger bearish halfway hesitation from all the action this year so far. It's a little too early to confirm this idea, but I thought it prudent to look at any potential targets on the downside. I'd suggest a preliminary target X in the 382.5 area. Please note, this very much depends on smashing this or that short-term uptrend." End of quote. Monday 5 weeks ago, the market closed below this new, now retired, short-term uptrend. As recently as 2 weeks ago, the market made yet another bearish action. This time a combined immediate countering key reversal down and bearish engulfing pattern and opening long black Mariposa. But the action failed, much as earlier ones have. This failure was magnified by the bullish long white Mariposa on Wednesday last week, punching up through the medium moving average, currently at 414.20, the short medium moving average, currently at 418 even, and the very recent 50% Fibonacci line at 423.5, closing above all three. Whilst last week was not a weekly key reversal up, the action on Wednesday last week threatened all three targets below. Target X for the bearish halfway hesitation in the 382.5 area. Target X1, an initial target for a possible roof stroke half diamond pattern, highlighted in red on my daily chart. That's in the 384.5 area. Finally is the lopsided possible diamond top pattern with a potential target X2 in the 379 even area. I finished the last 2 weeks' commentaries with this phrase. I quote, all roads here seemingly point to Rome, where Rome equals the 380 even area. End of quote. It looked like that idea was dead last Thursday on the open as prices gapped higher. However, this bullish open soon turned back down as prices ended up on Thursday with an immediate countering bearish dark cloud cover pattern, closing below both the short medium and medium moving averages. Admittedly, as I said last week, the bearish incentive has taken a body blow, but the bears have recovered. Targets X, X1 and X2 are still there, whilst the bulls have a minor victory as prices are higher than they have been for most of the past 3 weeks. Overall, this question on the patterns here still remains. Chicago soybean oil. 6 weeks ago, I drew a new acute bullish Andrews pitchfork from the late November 2020 to mid-January 2021 action. 2 Fridays ago, the market broke down through the lower time, currently 52.40. I think I'll quote the end of my commentary from 3 weeks ago, which covers this situation. I quote, please note, the incentive is still there, it's still bullish. We are still within the bullish Andrews pitchfork, and until this is retired or substituted, that is the way. The next supports are the March 2013 high at 51.26, the lower time, congestion around the lesser Fibonacci level at 48.94, the big 50% Fibonacci line at 48.85, and a new one, the 2021 50% Fibonacci line at 48.06. End of quote. The market tried to revert back up on Monday last week with a bullish harami, but failed to even hang a close on the lower time. This led to Tuesday's immediate countering bearish engulfing pattern. However, as I also pointed out 3 weeks ago, we have as support the big 50% Fibonacci line at 48.85 and a new one, the 2020 50% Fibonacci line at 48.06. The first 50% Fibonacci line slowed the decline, and the second halted it completely, admittedly helped by the rising short-medium moving average, currently 48.72, and the November 2020 to date uptrend, currently at 48.39. This gave us the following situation. Strong support below, but the reluctance to move back up into the old bullish Andrews pitchfork. Initially, there was even a reluctance to hang a price on the lower time. That is why I've kept the broken bullish Andrews pitchfork on my daily chart to see if the market would treat it as a clothesline. Well, it did, until yesterday, when we had a reasonably sized bearish engulfing pattern, closing back down below the March 2013 high at 51.26. One might therefore imagine a possible bearish action as follow on today, but no. So far, we have an indecisive doji cross. Since we are back where we were last week, just a little higher right now. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.